Welcome back to our channel today. We're exploring the potential ramifications of a Donald Trump presidency on Wall Street. As markets start to react to election outcomes, investors need to pay close attention to how different sectors could flourish. Trump's pro-business policies have a history of creating opportunities for growth, and his second term could amplify these effects. One significant aspect of Trump's agenda is the ongoing emphasis on corporate tax cuts. The Tax Cuts and Jobs Act of 2017 was a game changer, lowering the corporate tax rate from 35% to 21%. This pivotal move not only improved corporate profit margins, but also set a precedent for potential future tax reductions. Investors should consider how these tax policies could lead to increased earnings per share, EPS, providing companies with more capital to reinvest, distribute as dividends, or return to shareholders through stock buybacks. Particularly sectors such as technology, finance, and manufacturing stand to gain enormously. These industries thrive on increased capital to fund expansion projects, enhance innovation, and improve shareholder returns. Therefore, for those holding stocks in these thriving sectors, be vigilant during earnings reports. They might just reflect the positive changes in the corporate landscape fostered by Trump's administration. To sum it up, a Trump-led resurgence in the Oval Office could signal substantial shifts on Wall Street. His policies might shape not only company earnings, but also investor strategies. Keeping an eye on sector performances and overall market trends will be crucial as we navigate this potential new chapter in business and finance. Deregulation under the Trump administration has reshaped the financial landscape significantly, particularly with the rollback of regulations like the Dodd-Frank Act. This seismic shift allows financial institutions considerable leeway to lend more freely and invest aggressively. As compliance costs decrease, major financial firms are poised to see enhanced profit margins, fueling their expansion strategies. With giants like Goldman Sachs and JP Morgan Chase leading the charge, a wave of profitability could ripple through the financial sector, driving stock prices to new heights. Moreover, this trend toward deregulation could incite a competitive environment where innovation thrives, ultimately benefiting consumers as well. With less regulatory oversight, banks may engage in more dynamic lending practices, potentially leading to increased capital flow into various sectors of the economy. This environment fosters a stage where financial stocks can shine, transforming the market dynamics to favor aggressive growth. The conversation around infrastructure investment adds another layer of opportunity, echoing Trump's administration's commitment to rejuvenating America's physical assets. Proposals for upgrading roads, bridges, and airports signal not only vast government contracts for construction companies like Caterpillar and Deere, but also a surge in demand for raw materials. As these infrastructural developments unfold, material stocks such as U.S. Steel and Vulcan Materials could experience significant boosts, creating a compelling narrative for investors focused on both the financial and construction sectors. Therefore, monitoring infrastructure-related ETFs may prove advantageous in navigating this evolving economic landscape. Trump's enduring support for the oil and gas industry is unmistakable, reflecting a commitment to energy independence that resonates with fossil fuel companies. His administration's policies have consistently favored the expansion of drilling and fracking, promising a landscape riddled with less regulatory oversight. This approach paves the way for an upsurge in investment opportunities within the sector, making energy stocks like ExxonMobil and Chevron more appealing to investors keen on capitalizing on the growing demand for fossil fuels. As deregulation unfolds, the market is poised for shifts that could propel these established firms to new heights, turning investor attention towards energy ETFs and stocks. In tandem with energy policies, Trump's America First philosophy has left its mark on trade dynamics. While his trade measures may have stirred ambiguity on Wall Street, they spotlight a strategy aimed at bolstering domestic production. Tariffs imposed on foreign goods have the potential to shift consumer spending towards homegrown products, encouraging a renaissance in American manufacturing and agriculture. Companies that prioritize domestic production stand ready to benefit, navigating through a landscape where foreign products become steeper in price due to tariffs. This dual approach could invigorate industries that feed directly into the U.S. economy, fostering heightened investment enthusiasm. Nevertheless, the trade landscape is fraught with complexities. Sectors interconnected with global supply chains, such as technology, may experience turbulence as tariffs skew price structures. The volatility created by ongoing trade tensions introduces an element of risk, yet it also reveals strategic opportunities for businesses oriented towards the U.S. market. This environment compels investors to adapt, focusing on companies that can weather the storm of tariffs while seizing the benefits of domestic growth. Navigating these waters will require insight and agility, as the implications of Trump's policies continue to evolve, shaping a unique investment landscape for both energy and domestically focused sectors. In essence, Trump's policies are likely to yield divergent effects across various sectors. For those keen on energy stocks, the anticipated deregulation bolsters optimism, presenting a landscape ripe for investment. On the trade front, while uncertainties loom large, it offers pathways for domestic companies to flourish amidst increasing global tariff barriers. Investors must remain vigilant, carefully considering the implications of these policies as they craft their strategies in a dynamically shifting economic environment, ensuring that they stay ahead in an ever-evolving market. At AlphaBridge Advisors, we empower investors with actionable insights and cutting-edge resources. Our mission is to bridge the knowledge gap, providing expert guidance on market analysis, investment strategies, and risk management. With unbiased research and tailored support, you'll make informed decisions and optimize your portfolio. Join our community today to access exclusive reports and strategic insights that keep you ahead in the dynamic investment landscape. As we delve into the intricacies of market sentiment, it's crucial to understand Wall Street's generally favorable reaction to Trump's policies. The optimism surrounding his tax cuts and deregulation initiatives has set the stage for a potential rally in the short term. Investors, often swayed by optimism, are likely to seize the moment, fueling a sense of buoyancy in the markets. This environment can lead to a surge in stock prices as confidence grows amongst market participants, paving the way for exciting opportunities in the immediate future. However, it's essential to approach this optimism with caution, as Trump's policies can also instigate market volatility. The interplay between trade negotiations and foreign policy decisions can introduce uncertainty that may shake investor confidence. The potential for sudden shifts influenced by global dynamics means that while the market might currently be riding a wave of positivity, unexpected turbulence could arise at any moment. This duality of excitement and risk is a staple of the financial markets, and investors must remain vigilant. When considering sector-specific ramifications, industries like finance and energy seem poised for potential growth under a Trump presidency. These sectors could thrive, leveraging the favorable regulatory environment and tax incentives aimed at stimulating economic activity. Conversely, the tech and retail sectors might face a cloud of uncertainty, influenced by evolving trade policies and regulatory scrutiny. Recognizing this landscape provides a clearer picture for strategic investment decisions. Volatility, while daunting, also presents unique opportunities for adept investors to adjust their strategies and capitalize on market fluctuations. Ultimately, the bottom line rests on a delicate balance. A Trump presidency could herald promising times for Wall Street, particularly for those heavily invested in sectors like financials, energy, and industrials. However, prudent investors should remain keenly aware of potential volatility, especially as trade policies come into play. Staying informed and adaptable will be paramount as this new political landscape unfolds. As you navigate these waters, remember to regularly reassess your portfolio to align with changing market conditions. If this analysis provided valuable insights, consider liking this video and subscribing for more updates on how political shifts influence your investment strategy.